You've heard the saying, make your money work for you. But again, how?
Well, like we said last time, it's more than just investing in index funds or stocks. It's using strategies, simple ones, that you can use to make your current cash or stocks generate more income for you.
Today, we've invited Nate Thomas, better known as Trader Nate, on Twitter, back to the Queer Money Podcast to share with us the flip side of the conversation we started on episode 404 about covered calls.
And today, you're listening to Queer Money episode 414, and we're discussing cash secured puts, a simple, easy way to make more money with the cash you have in your portfolio.
So let's get to the flip side.
The mission of Queer Money is to financially empower the LGBTQ plus community. Join us in thanking Capital One for supporting that mission. Welcome back to another episode of the Queer Money Podcast. You're going to see a familiar face on this week's episode.
We've never had a guest come back so quickly.
Yes, exactly.
This is the first time, so
yeah.
Congratulations.
Happy to be back. Yeah, Trader Nate is joining us again to talk about options. And this time we're talking about protective puts. And folks, the reason why we are having Nate back so quickly is because we really did want to cover options in one show. And we realized after kind of talking through this and talking with Nate that it probably would make sense if we broke these into two, keep the confusion separated. So let's start this over again. And what are options? And folks, if you haven't listened to episode 404, go back and listen to that because we had the discussion around what covered calls are. And now we're taking the other side of the teeter-totter and we're looking at protected puts. So welcome back.
Thanks again for having me. I'm glad to be back.
Definitely. Let's kind of just so that we can catch people up to speed who didn't listen to that episode. What are options again?
Yeah, sure. I'm happy to get right into it. So options are really very simple and a basic contract that, the buyer is given the right to buy underlying shares, 100 of them per contract, at a specific price by a specific date. They have that right. It's not an obligation. And that's really the long and short of it. There's a seller on the other end of it who is obligated if the option contract were to be exercised to fulfill that option, to fulfill that contract. And that's really how it works.
And on episode 44, we talked about option strategies that can help you make some money with the positions that you already have in your portfolio. Today, maybe it's very timely. We're going to talk about how you can use options to sort of protect your portfolio if you see the market dropping or your positions dropping. You have another name for what you call protective puts, a more accurate term. What is that again?
Yeah, so there's a strategy, it's cash secured puts. And we can talk about that, certainly.
Awesome.
Which is also kind of an appropriate thing for right now because a lot of people are not comfortable with what's going on in the market, so they may have pulled a lot of their portfolio into cash, have a larger position of cash. So this may be some way that you can use that cash to make yourself some money. Is that kind of right?
That's exactly right. So let's just talk about the cash secured puts strategy and just get right into it. So. Sure. The options contract is an obligation or not an obligation, a right to, if you're owning the contract and it's a call option, like we were talking about last time, you can buy those shares at that strike price. And then as long as it's a good opportunity for you and it's within the duration of that option. So if it expires in a month and you're within that time frame, then, the call option is a way to capture upside and what have you. So the puts is a way to protect the downside. And so what a put option is the right to sell shares at a certain price. So if I were to buy a put contract that is at a $10 strike price, for example, that allows me to sell 100 shares of the stock at $10 a share. Why this might be good is maybe I own shares of a stock that I bought at that $10 level. And I want to protect any downside, losses below that level. What this put does is it gains value once the shares drop below $10. So effectively what you're doing is you're buying a put to, offset any losses of the shares you already own, right? So that's just buying a put And that's the basic long and shorts of that. The cash secured, and when you were talking about having cash because you've moved into a cash position, those are cash secured puts. So that strategy is where you have the cash in hand, and using that $10 100 share example, right? So you have enough money to cover 100 shares at $10 a share, so $1,000. But you don't want to necessarily buy it at the price it's at right now. Maybe the shares are at $11 or $12. And so you're like, I think it might pull back to 10. I'm happy to buy the stock at $10. But I don't want to buy it where it's at. So you can engage in a cash secured put strategy where you're selling that put at the $10 strike price, which obligates you basically at that $10 price to acquire these shares. So it might sound a little bit confusing when you get to that point, but the idea is you have a set amount of cash. You're going to set that cash aside as you're saying, I'm willing to obligate this if I have to buy these shares. Meanwhile, you're collecting cash because you're selling that put that's saying, okay, I'll buy these shares at $10. And so you're able to collect additional cash on top while you're waiting. So the long and short of it is you're able to use your cash without getting into an actual stock position at the current levels, but you're able to collect some cash.
Nice.
Got you. And so there's a little bit less risk in this scenario because you actually already have the cash. You're not going to be assuming, you're not going to be obligated to take the shares and not be able to figure out how you're going to cover the cost of that. You already have the cash in your portfolio.
That's right. So the two kind of scenarios that aren't great when you're using the strategy is if the shares drop dramatically. So if they were to drop all the way to $5, for example, you have a huge gap between that $10 and that $5 range, and you're effectively going to be acquiring them at $10. So now they're only worth $5, and so it's not as ideal. But on the flip side of that, if the shares take off, right, and they never go down to $10, well, you collected your cash premium, which was nice from selling the cash secured puts, but you never bought the shares, so you don't get any of that upside, right? You missed out. The put you sold, that contract is going to expire worthless because the shares are higher, and therefore nobody would exercise that, or nobody would find that valuable, and so you just miss out on a lot of upside, I guess is what I'm trying to say.
Yeah. So when we talked about the covered calls on episode 404, we said that this was a very kind of entry level, basic way of getting into options. Are protective puts or cash covered puts, are these maybe a next level up? Are they a little bit more complicated, or where would you put them on your level of knowledge needed for doing these?
That's a great question, and I definitely recommend getting comfortable with call options first. It just works more naturally with how we think, right? Stock goes up, the call options go up with it, and it's worth more, and vice versa. So with puts, you have to think inversely, and it's just a little bit trickier to do. Again, with the call options, you have the right to buy at a certain price. With a put option, you have the right to sell at a certain price, which seems weird if you don't own any shares, right? Like, what am I selling? Well, you're going to have to go buy those shares and then sell them at the price that the put option says you're obligated to sell at. So if you don't already own them, then that could be a problem. But if you have the cash secured put in place, then you're good to go. It's going to cover your cash that you're going to have to outlay, and hence the less risky option, less risky position. But it is more complicated than trading in calls.
Yeah. So in this instance, before it was a little bit easy to understand who the buyer and the seller is. When previously with the covered calls, the seller was the person who owned the shares. They would go out and sell this contract. Who is the buyer and seller with the cash secured puts? Is it the same?
Yeah, it is. So if I'm in the cover, so I'm going to be the seller in this example for both. So in the covered call example, I own the shares, and I own 100 of them, so I will sell the call, and whatever happens, I have the shares to back that up. In the selling of a cash secured put, you don't own the shares, but you own enough money to cover the obligation you have at the strike price to sell those shares. So to use an example, if you wanted to, let's use Rocket. I think we used Rocket last time with our covered calls, right? And so if you wanted to buy Rocket, if you're comfortable buying Rocket at $9, but it's currently at $10 a share, and you don't want to buy it there, you think it's going to maybe pull back, or there's just more risk involved. Very similar to how you can engage with a covered call, you can engage instead with a cash secured put. So you're saying, okay, I'm willing to spend $9 a share. So I'm going to take $900 because 100 shares, right? I'm going to set that aside, and you won't be able to touch that. You can't use it at all. It'll be locked up by your brokerage account when you engage in selling the put against those shares or against that cash. And so when you sell the put, you're saying, the person who is, maybe it's easier to explain from the buy side, the person who owns that put is able to sell you, they're able to sell shares at that strike price, right? So you're obligating yourself, and I think I might have said that a little bit backwards or confusing before. You're obligating, I'm going to buy $900 worth of Rocket at $9, no matter what the price, drops to and gets lower to. So that's where the risk comes in. If it does drop much below that $9 price, well, you're going to end up paying $9. But at the same time, if it doesn't get that low and it just kind of moves sideways, similar to the covered calls, you're collecting cash and you're not owning anything. You're just setting aside that $900, and you might be able to collect $20, $30 at a time as you're selling these cash secure puts.
Tired of all the credit card offers you get from your current credit scoring app? Download CreditWise by Capital One today to avoid them. So you mentioned this idea of that the brokerage firm might lock up my money, which kind of sounds scary. So what are some of the requirements when it comes to buying and selling cash secured puts?
It's the same thing as the covered calls. So it's very low level because it is considered lower risk. So it's a zero level options trading request from your broker. And then when it comes to the locking up the money, because I agree. As soon as I said that, I was like, oh, wow, that doesn't sound so great. Really what you're doing is you're saying, I'm willing to buy shares at, $900 in that example with Rocket. If that's the case, you have to have the $900. That's the obligation. So you can't engage in this with $50 in your account. You have to have the $900. And but when you're locking it up, really what they're saying is, well, just close the contract and you have your access to your $900, and you can trade it how you want. So it's no different than any other contract that you would be engaged in.
All right. So I don't want to make this too confusing, but let's kind of go back to some of the terms that we're using in episode 404 around this idea of strike price and break even. And because I think a lot of us want to know, it's really easy, right? When I buy a stock, it's really easy to know when I'm making money and when I'm losing money, because it either is going up or it's going down. But when you have these options trades, it's a little harder to understand, okay, when am I making money? When am I not making money? When would I want to exercise? That's the word when you say you want to actually make the contract take place, right? I want to either buy or sell the shares. When does this happen, or how does this happen with these cash secured puts?
Yeah, I think it's great to break this down from just getting into each element. So let's go calls and then puts. So the call example, because I think it's nice and simple. If you are buying a call, you want things to move up, right? And if you are selling a call, you're on the other side of that, right? Because there's two sides of every transaction. So if you're selling the call, you actually, because the call is for upside, you want things to stay flat or move down. So that's the buying and selling of a call. So a put is the exact opposite. If you are buying a put, you want things to drop because you believe, that's the direction things are going, and that put will go up in value. If you are selling the put, you're not worried about things dropping. You think things will stay or move higher. And so you can make some money off of that. So you're taking a position and you're using one of these two mechanisms, right? You can use either, quite frankly. And there's a lot of more math. Sorry, John. But there's a lot of math out there that shows you, puts and calls are effectively the same thing. They just used different, you can just use them a little bit differently. And, but as I kind of outlined there, it just is taking a position. If you're a buyer, you're long. If you own a call, and if you own a put, you're short. You're expecting things to drop.
And this does seem counterintuitive because you're expecting the market to go in the opposite direction than you would think if you were the buyer versus being a seller. But there are some simple infographics online that you can find that really break this down with simple pictorial rather than all the mathy stuff.
Yeah, I agree. I'm bigger on pictures too. Maybe I should start creating some of these pictures, actually.
It'd be great for a course.
Yeah, that's a great idea.
Yeah. So when might somebody want to get involved with, when we were talking about calls on the previous episode, we were talking about times when people would maybe find these useful, and that was when the market was either trading sideways or going down. Is that the same case with puts, or what's going on with puts? Do you want the market to be going down? You want the market to, is it when the market's flat? When do you make money when you're using these kinds of options?
Yeah, great question. So two elements to this. One, if you own shares of something and you want to protect any downside without selling those shares, so you don't want to have a taxable event, but you do see or feel like there might be some downside coming, and you want to protect against those potential losses, you can buy put options. And what that does is, if the shares are dropping in value, you're losing that money, but the put's going to offset it by rising in value at the exact same time, right? So, and then you can sell that put that you had bought, collect that cash because it increased in value, and offsets some of your losses in your shares. That's the basic utilizing puts to manage some risk. And then the cash secured put is you're taking a similar position with the covered calls. You're saying that I don't think things are going to move very quickly in either direction, so I want to collect some cash. And using a cash secured put is a way of doing it without actually owning shares. So if you already own 100 shares, the covered call is definitely, if you're looking between these two options, you're going to look at a covered call. You own the shares. But if you don't own them and you may not want to buy them where they're at, then the cash secured put is an option that allows you to have the ability to buy at a lower price. But if it doesn't get there, you can collect some money for obligating your cash for a short period of time. So I think that's really the breakdown of the two ways to use puts, at least from a beginner standpoint.
Right. So it sounds very mathy and it sounds very taxable. So just to be clear, this strategy, same as covered calls, can also be done in an IRA account as well to sort of avoid those taxable consequences.
Yeah, that is correct. And again, as I mentioned last time, I actually prefer in an IRA, in a tax deferred account for that exact reason.
Perfect.
Does make a lot of sense. So I know that all of this can sound kind of complicated, but this is something that is that next level, right? And we mentioned this on the previous episode, is that you've been asking for this, and this is part of the investing series for the Queer Money Podcast, so that you folks can start to stretch your knowledge. I think that both the covered calls and the protective puts are a great way for folks who are who have something in their portfolio, but maybe don't feel like this is enough that will allow them to feel comfortable and be able to retire. Especially if you're looking at 5 to 10 years out for retirement, this may be something you may want to do to kind of add that extra 2 to 3, 4% growth to your portfolio. And as you mentioned, Nate, these are not necessarily risky strategies if you know what you're doing, right?
Yeah, and I would even say, as long as if you understand what you're doing when you're buying the stock, all right, if you're comfortable with investing in stocks already, then really you're not adding risk by engaging in a covered call strategy, for example, or in a cash secured put a strategy. What you're doing is you're capping your upside and you're managing a little bit of risk. So you're actually offsetting risk, and collecting, able to collect some upside in the meanwhile. And why that really works well in a sideways market is, stocks will move up, but then come back down and move up and come back down. And when they come back down, that's the area where you're buying the shares. But when they move up and they kind of stop and they reverse, then you're selling those calls or, cash secured puts or what have you. And you can rinse and repeat and make money while others are losing money or, are flat on the year. So where these really help your portfolio is in those markets that are moving sideways or slightly down, and you're able to still generate cash and add value. And then, I think we talked about it last time, in those markets that just take off, that's when you want to reassess the strategy.
Yeah. Right. The markets that we're all hoping for, but don't always happen on a regular basis.
Well, the one market, we don't want the other market that Jamie Dimon and everybody is doom and glooming about.
That's true. Yeah.
So sideways or up.
Yeah. I mean, if I have to abandon a covered call strategy because the market is going up double-digit percentages, I am happy to do that.
Exactly. It's not a sad day, right?
Exactly. Right. Yeah. These are not the kind of strategies that are going to, unless you have a lot of cash or you have a lot of shares, these are not the kinds of strategies that are going to make you a ton of money, right? It's the percentage growth of what you have. And, you did mention this, I can't remember if you mentioned this time or the previous episode, that this is something that you can do to get that couple of extra percent for your portfolio. And a lot of people, that's just what they need. They need that little boost every year or every couple of months to have that extra 1 or 2%. And when you're in retirement, this could actually be a way of generating some income, right?
Yeah, absolutely. And if you're in a position where you have a nice size brokerage account and you already have a good, cash position or shares, ownership of hundreds of shares of stocks, then yeah, for collecting income, it's a great source of, it's basically, I consider it passive. It does require some active trading, but with a few trades a month, you can generate income definitely. And that's another reason people are interested in it.
And love it. What would you say? How much knowledge would I need to know about the respective stocks that I am doing this with? I'll say that I know I'm not alone in doing this, purchasing shares of a particular company and then kind of having that kind of buy and hold long-term philosophy. How much should I know about these companies and their monthly, quarterly movement to be able to actually take these steps?
Yeah, so I think that it makes sense to have a decent understanding of where a share moves with its price. So let's use another example. I think Apple is a good stock that a lot of people own. And if you own Apple, you have, it's somewhere around, I haven't checked it recently, but it's somewhere around $160 a share. And so you can collect cash by selling, options against your shares of Apple. And I guess the what I would caution against is when you do own those shares and you like your shares in Apple and you're investing long term, like you're talking about, then you don't want to be too aggressive with collecting cash using a covered call strategy or a cash secured put strategy because the covered call strategy, because your shares could get called away and you may not want that, right? You may be thinking, I actually want to hold these for the long term. So I just wanted to comment on that really quick. But what I would say is from a knowledge standpoint, you need to understand a little bit about where the price moves, because when it gets to a level that it's kind of maxed out before and struggled with, well, that's the area where you would be actively selling covered calls because you don't expect it to go above that level. So that's where you kind of determine what price to set when you're selling a call. So if you see, Apple was hitting 180 or something and constantly pulling back, well, you might feel comfortable selling a call at $180. Or if you are seeing that, conversely, maybe you don't own Apple, but you want to use a cash secured put and you don't want to buy it here, then you have the cash secured put that is, at 140 or something like that, a lot lower. You want to know that that's the level that Apple tends to drop to without flying through it. Because if it flies through there and you end up buying at a higher level, you're going to be losing money or making less money. So understanding that kind of, and you can use charts. You don't need to know balance sheets and income statements and, get huge. This is one of the reasons that I enjoy trading is that, I don't know anybody who has the time to really dissect balance sheets at that level, but you can use charts, and that's
Jim
what
Cramer
I
does.
Well, I think at least he's doing it full time, right? I mean, but yeah, that's what I would say is that, you want to understand how to read a chart and general price levels, but it's not something that requires a ton of knowledge and study. It is really just a general understanding so that, okay, this is where it usually stops. So I can, set strike prices around that and be smart about how I execute the strategy.
Awesome. And this is the kind of thing that you share and talk about on Twitter, and that's what we appreciate, and why we
Thanks.
invited you on the podcast is to share this kind of information. So, and you mentioned previously on the previous episode that you also have a newsletter that you share with folks that has this kind of information. So, how can our audience connect with you on Twitter and then your newsletter?
Yeah, so on Twitter, it's at Trader Nate here, and I'm active. I appreciate all questions. I'd like to talk trading at any time, really. So definitely feel free to send me a note, drop me a message there, and follow. And then I have a weekly newsletter where, it's free, and I try to just really get education out there. I love to teach, and I love educating people on this because it's been something that's been beneficial for me, and other folks have taught me along the way. And so that's what I'm doing with my newsletter. I enjoy writing. And it's a trader's education. It's on Substack. Currently, I have a link in the Twitter bio as well. So yeah, if you're interested, I try to keep it very easy to read and easy to digest so that, folks can get interested.
Awesome. We'll definitely link to that in the show notes, folks.
Yep. Thank you for coming back on the show. We appreciate it.
Yeah, thanks for having me. I really enjoyed it. And again, if there's any other questions about options, I'd be happy to come back on. So thanks again, guys.
Thank you.
Start your journey to financial independence with a checking and savings account that doesn't nickel and dime you with fees. Get a Capital One 360 checking or 360 performance savings account at Capital One today.
Thank you again, Nate, for another great interview. We really appreciate it. I'm sure our listeners and our watchers appreciate it as well. For those of you who are listening and watching, thank you. We appreciate that. And here's your Crew Money takeaway from this particular episode. There are ways to supercharge your retirement portfolio to generate income for the future. Follow Nate on Twitter and check out his newsletter to learn more about how you can add cash secured puts to your portfolio growth.
Then join us this Thursday when we share the most affordable LGBTQ plus friendly city to live in North Dakota, and next Tuesday when we talk more about financial independence and retiring early. Thank you and have a great week.